Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for for the weekend of July 17, 2022. Got thrown by the title, which is Did Friday Rally Change Anything? My email address is hgsidoc@gmail.com. If you're new, then up on the YouTube site, there's a place to subscribe and then an alarm. If you hit both of those, you'll get notification when these are placed there, usually on Sundays by lunchtime. Occasionally I'll do things here intra-week. I'm very open to hearing comments. What do you think about what I'm saying? Do you agree, disagree? You got any thoughts about the tools that I use? And then thumbs up or thumbs down. All that's appreciated. Without feedback, no one ever gets better. As always, this is for educational purposes only. Anything I recommend in the spirit of education should not be considered investment advice. If I talk about a particular stock or option, it's for education only. I'm a doctor, not a broker. I paid for the tools that I use, and trading involves risk, and you are solely responsible for any investment decisions you make. For those that wonder why I do this, the genesis started as doing volunteer support for highgrowthstock.com, of which you can see my emails, a derivation of that. And I've branched out to other programs, and I've sort of kept the same mantra to do free web-based, mostly education about how to use the tools and how I use the tools to apply to current markets. And then occasionally I'll do live seminars. I still work in healthcare. I don't practice anymore, but I have a healthcare technology company that I'm involved with. I do post something every morning at stocksanddocs.com, and I sometimes record them at night, sometimes first thing in the morning. Typically they're recorded and posted by 9:30, and if you fill out the little form on the site, you'll get notification when I post. They're very short. They're designed to take a look at before the market opens in about 5 minutes or less. Let's talk about the markets. I just take these snapshots out of what's called a warehouse view in the highgrowthstock.com product, and it gives me some sense of what's going on with the market. I've listed on the top set some major market indices. I've highlighted in yellow the major indexes, and then I've got the sectors. I usually go over here, and this tells you a lot, that the dollar is right off the high, and it's 1 day off the high. All right. Everything else is double digits down. Bitcoin, the worst performer, down 75%. ARK 65, IBD 50 ETF 48%, and FANG down 38%. Now these are off their 52-week highs, and you could see that those occurred between September and November of 2021. So we've been in a downtrend for a long time. Biotech, which is actually up 18.2% up over the last 29 days, is still down 30%. So you get a sense of how beaten down the markets are. The big caps are down 15 to 17, and the NASDAQ and Russell are down just under 30. Now over here, days since the low, you could see that the NYSE set its low just a couple days ago, and it was up 3.3% since then. The other indices, the Dow, the NASDAQ, the Russell, are about 28 or 29 days off their lows, and they were higher, but they're still somewhere between 5 and 8.5% up. I just learned a lot there. It gives me a sense of how the market's been doing and how large caps have outperformed, and the only place that's been safe to leave your money is in cash. Okay, what else can I see from here? I can see over 5 days. All right, remember the title, Did Friday Mean Anything? The dollar was up, the VIX was up, the bonds were up, natural gas was up a lot. Wow, that's not what you expect to see from a bull market, is it? So it really was a sort of the things that are not stock market driven, that are more commodity, volatility, US dollar driven, were up. And if you look over 1 day, you can see the opposite, where the dollar was down and gold was down and everything was up. So Friday to me looks like a one-day wonder. We'll see what happens this week. Hope not, but all you can say right now is you had a really great Friday, and things that had lost the most. And natural gas is just rebounding after a horrible pullback. But Bitcoin and ARK, besides natural gas and the VIX, led to the upside on Friday. The VIX leading to the upside on Friday is not a good sign either. Although that's short VIX, so that's okay. Now, if we go over here and you look at sectors, you could see that on the 52 weeks, everything's down 10% or more. The only things a little bit less than 10 are healthcare and utilities. Energy, which was leading, is now down 26.5%, which is impressive. Again, the only thing up on Friday was staples, defensive, and everything else, up on the 5 days, and on the 5 days, everything was up. So, all right, let me say that again. The only thing up on the 5 days was staples, but on just Friday, everything was positive, reflecting the big rally that we saw on Friday. If I go into Sager's Q Edge, you can get a sense of how strong Friday was, where all sectors were up, 97% of the industry groups were up, and 94% of the stocks were up. Here's that sitting here. If we look at over 2 days, still great on the sectors, but some erosion on the industries and stocks. And if we look at the week, it's decidedly bearish, with 82% of the sectors down, 58% of the industry groups, and 57% of the stocks. So that super powerful Friday rescued the week from a horrible, but it's still a negative week. Over 2 days, 2 weeks, it looks better, and over a month, the markets have been kind of 50-50. The warehouse report tells me what was working. So the good news is when you see more losses on low EPS rank than high EPS rank, on low relative strength rank than high relative strength rank, that says that relatively speaking, growth was in play. When you see this curve from lower left to upper right, this is favoring high ERG or high EPS rank, high relative strength rank, high group rank stocks. So growth was working this past week. The problem is pretty much everything was below 0% return. So growth did show some life, but not in a way of big performance, just outperforming the value sections. Now, the most important thing here, and we're going to talk about it in wealth charts, is probably the weekly bongo. This is just a collection of data going back about 5 months. And what I want to look for are evidence of the Hindenburg omen, new highs, new lows, etc. And what you see here is if you look percent new lows, we're not in double digits. We were as high as 25, 18, 26 a month ago. But we still have more new lows than new highs. There haven't been more than 2% new highs since April. So I still think there's a problem with the buyers, but maybe the sellers have slowed down some. Up here is just a chart so I can see where we've come, where we've gone. And then this is the chart in HGSI. And it has a lot of information on it. But again, the bongo here, I got this chart, is reversed. Let me see if I can fix that. It's a mirror image of the chart because the bongo today is red. I didn't know you could do that. Yep, there we go. Look at that. Turned it over. So you can see the bongo's been red ever since December. And I'll talk about that and what that should have meant to us as far as being in the market. That's the NASDAQ. The NYSE, similar red bongo. Now, the NASDAQ had a Eureka, which is a follow-through day. The NYSE, a Eureka, which is a follow-through day, and a Kahuna, which is a big volume momentum day, or big move day, not volume. So that's a little bit of bullish stirring. Their new highs and new lows were both below 2%. Actually, the new highs picked up some. But the same thing, lots of new lows for such a long time on the NYSE. The buckets, similar to what I do with Q-Edge, it gives me a sense of where this market is from an overbought, oversold. 62% of the stocks are above the midline in their Bollinger Band. That would be a little bit bullish. And you could see here sort of a bell-shaped curve, which is neutral. This here, which is very bearish, is actually good because when the market gets very oversold and 96% of stocks below the midline as it was June 17th, it's very predictable that you're going to have a reversion to the mean. Here, there's nothing predictable about it. That's pretty neutral, maybe a little bullish. Energy this week, you could see natural gas was the standout in the US and it was down in Europe. Down in Euros oil was interesting, down 11%. And if you look up here, US oils was down 5 or 6%, gas was down 6%. So a decidedly negative looking week on the energy front from the raw materials except for natural gas. But even with those returns, natural gas is still down on the month, albeit very positive on the year. On the metals, weekly metals, pretty much when the dollar is strong, these things are not. And the dollar is super strong, and whether you're looking at a little bit down on gold or silver or way down on iron ore, and look at 4.29% down on Friday alone. Silver is showing a glimmer of hope, the first one off the mat with the dollar easing a bit on Friday. Now, I'm seeing some stirring in stocks like Starbulk shippers, and that's probably because we've come back a little bit. Perhaps we've stopped falling on the Baltic Dry Index. I still can draw a trend line that says we've broken below the trend line, and I'll be worried about getting back above that trend line, but the fact that it turned up shows some strength in that type of shippers. Interest rates, you could see here the 10-year rate, the 30-year rate actually came down this week, which is interesting despite a very hot CPI and PPI and more talk about 100 basis points or at minimum 75 basis point raises. If we look at the credit risk spread here, we can see it continues to march higher, although it's off the most recent highs. And then if you look at the inversions, and I pulled this chart back to 1980, because the point is when you see reversions, you see recessions afterwards. Reversion, recession, reversion, recession, reversion, recession. So it's pretty likely that we have a recession coming, but is that really new news? And the reason why this is important is because you could see here what happened at the end of 2018 after you saw this blip here in the credit risk, tightening getting money. I'm hearing from so many companies that are having trouble raising money in the capital markets. The market sold off. This is something the Fed is watching, I am sure, and something that they're stuck because probably the risk is going up because of inflation, yet the thing that will stop inflation, raising rates, will probably make the risk go higher. So it'd be interesting to see how the intelligent folks at the Fed can figure this one out. If we look at stocks above the 200 and stocks above 40, really didn't change much on the week, perhaps just a little bit less. While the shortest one, the 12-week new high, new low, actually picked up. So we got back here to reversal territory, and now we're going back higher. This really doesn't tell me anything. It's when I'm at extremes here, when I'm going to turn down, extremes here when I'm going to turn up, that makes a difference. Newsweek, there's still important things. You got jobless claims and manufacturing, leading economic indicators, and then you've got PMI. So I don't think there's such a thing as unimportant news with the markets the way they are and the inflation numbers. And in fact, what probably drove Friday's rally was some positive consumer sentiment. This is probably the biggest news, and as I've said before, it is a judgment call to hold the stock over earnings. It is bad judgment to not know when your earnings date is. So I entered some Bank of America last week on Friday with the positive numbers of Citi and I think Wells Fargo, and I actually have got protection on that position where I bought some puts and sold some calls out of the money. My guess is Bank of America will look more like Citi and Wells Fargo and less like Morgan Stanley and Goldman Sachs. But, you know,
My bet is they do well and Goldman Sachs does bad based upon last week, but we don't know that. It's rolling the dice. So I knew I had earnings and I protected myself. Had I not made some decent money, and it was up $2, which is, you know, a big percentage for Bank of America. Had I not had those gains, I probably would have just taken it off the table. You can see various other stocks that are big: IBM, J&J, Halliburton, Netflix, which has actually got an interesting chart pattern right now. I hope I remember to show it to you. ASML, a semiconductor stock, more banks, Nokia, AT&T, American Express. This is a busy week of earnings. Expected moves. How did the market fare last week? You could see if we look at the S&P, the opening or the close on the prior Friday was this gray line, traded down Monday, Tuesday, Wednesday, had a clear reversal candle on Thursday with a big bottoming tail, and Friday powered itself back into the range, but all that did was kept the option sellers from losing money. It still finished in the bottom half of the expected move range. Same thing with the NASDAQ. Pull this over here. The Russell, the Dow is up there. The Russell, they all look the same. The VIX did come down on the week. And then over here, you could see the dollar had a reversal on Friday, which probably led to why there was strength in silver, and maybe in the market as a whole. Stock market endured another volatile week. 3 days of selling, ended with a rebound. Indices came off their lows. Still, the major indexes were down on the week. We had CPI concerns, global growth concerns, talk on energy rationing, political turmoil with the Italian prime minister resigning or trying to resign, and then folks in China deciding they didn't have to pay their mortgages. As I said, CPI and PPI were hot. Heavy week of earnings. Friday was super strong after some earnings and the consumer confidence, but really volume was not impressive. So we're still in a bear. Likely to see continued rally attempts. For now, we should consider those short-term opportunities till proven otherwise. I still think cash is king. It's okay to play these bear market rallies, but you got to keep market context in mind. No FOMO, smaller position sizes, stops, and think shorter time frames. When the rally fails, I'll be buying contra ETFs. Just to remind you, stocksanddocs.com, it's up there, and I'm trying to put some good content, and it's free. So let's take a look at the markets. This is wealth charts, and let's just make the spiders bigger because I think you'll see the similar pattern on the others. So I want to start with by talking about 3 legs down. This is the first leg down. This was a steep second leg down. We're in the midst of a complicated third leg down where we pull back. This is the June low and pulled into this. And I guess the important thing here is if I want to be a believer is we broke above this trend line on Friday. So that is one piece of information that is possibly bullish. The volume was not great. Our daily bongo's green, but our weekly is red. The yellow line is the June low. Please let that hold if you're bullish. The white line was the peak in February or January before the markets rolled over in 2020. And then the red line is where they fell down to, which I think, hopefully we don't see that. But boy, if it got to this point, I'd be buying everything in sight because that would be a tremendous pullback. So right now, all you could say is we're in the midst of this third leg down. We are in a rally attempt, and we broke above trendline resistance. What do I think we can get to? Well, if we can take out the 50, we set a higher high, which is great. The next resistance is probably up here in the area of the 200. I would be very surprised and pleased to see the spiders get there. I just don't expect it. Similar pattern on the Qs. The diamonds, the Russell did not quite take out the trend line. The VIX was weak and the dollar gave up a little bit. If I look at the commodities chart, you could see that gold and silver had green bars. I think gold was down
and silver was up. But they both have indecision bars, and they're both way off their lows. Energy, you can see oil did not quite get to the 200-day and has bounced, but is still way off the highs. And natural gas penetrated the 200 and bounced and is also way off its highs. And the 10-year, despite the hot CPI and PPI, and despite popping above 3.1% for a heartbeat, is still below 3%. Now, from a timing perspective, I talked on my Wednesday Wealth 365 event, which is only recorded and posted on their site, and you have to be a Wealth Charts member to see it. I talked about the weekly charts. I talked about the 30-period SMA. Someone recommended I look at the WMA, that's the white one, and talked about the weekly bongo. And then I related these to Stan Weinstein's market cycles. And I said that the breakdown below the moving averages and the weekly bongo were a clear signal that we've entered a stage 4 pullback. And so I'm going to be looking for reasons to buy, but I'm not going to get excited until we move into a stage 1, which is a sideways move. And then potentially a stage 2 when we start to see breakouts working. Now, individual stocks could be in a stage 1, 2, 3, or 4 now, but when I see the spiders rolling over with the red bongo below the average and the same pattern on the Qs, the Russell, and the diamonds, it tells me how weak this market is. The other thing that's somewhat shocking is that, let me see if I can even show you. Hold on one second. Well, I'm not going to bother. If I look at all the recent bear markets, the bull market rallies were enough to turn the weekly bongo to green for short periods. We haven't done that once. I'm worried about this market, and hence why I put in some targets that are pretty much way out of the money and probably below what anybody on the street would dare to talk about. Themes, longer term, large cap, and value are still in play. But when I get down to the shorter time frames, you could see the IWM has come off the mat. Up here favors IWB, large caps, down here IWM. So we've pulled from large to small. So small caps are starting to show some movement. And then the other thing that happens, if you look at the spider growth versus value, growth up here, value down here, where the long term is pointing towards value, the short term is pointing up towards growth. So we probably have some market theme rotation occurring. If I look at the hourly S&P sectors, I'm looking for things that either had big green moves on Friday like technology did, or are pointing up at the right upper quadrant here. My stars were financials, which had a big move on Friday, technology, and healthcare, and these are ratio charts of looking at the S&P, the sector versus the spider, and you can see things like materials have gotten clobbered of late. Industrials, which showed some life a few days back or weeks back, have gotten clobbered as well. Now, if I apply those same timing ideas to the S&P sectors, the 30-period moving average and the weekly bongos, every one of these weekly bongos is red. So not only is the market weak from above, there's really nothing here that says buy me, buy me, buy me, that I have strength, I have strength. And yes, healthcare has held up better than others. Utilities have held up better than others. And, but everything is red, and I'd still be very careful. Now, if I go into my scanners and I go into the sector scanner to start, you could see that on Friday, the only thing that was down was communication services. If you look at the week, consumer defensive staples, healthcare, interestingly, some discretionary industrials and real estate showed some interest. So what I do as a top-down guy, and so my markets is maybe we got a little bit of a bull run, but I don't think we go very far. I still think longer term we go lower. That's my top line. From an industry group, I already showed you what I liked back here where I put my stars. For an industry group, I'm liking financial short-term, technology, and healthcare. So what I could do, and I've already done this, is I could get my healthcare, my technology, and I know financials is right in front of my face. I could hit compare, and then I could look at what's working in these right now, and so I could maybe take down to here, and this is very arbitrary, hit that, and then I can hit compare, and I'm going to bring up all the stocks in those groups, and I try to ignore these things with triple digit gains because they're usually things that are not tradable, or they're warrants, or they've already had their move. And then I might take everything that was up more than, say, 4%. So here I'm being top down. I've identified the strongest sectors, then the industry groups in those sectors, and then I've got and I've already done this once, but I'm showing you what I do. It's called Weekend Review, and I'm going to just dump all these stocks to my Weekend Review watch list. So now I've created a watch list, and this watch list also includes my combo leaders, which comes from pulling from a lot of different places, some HTSI, TradeStation, Thinkorswim, and other scans. And now I can then go and I can work with that. Now before I do that, I want to look at Wealth Scanner. Wealth Scanner is a very interesting tool where you can put a boatload of stocks, ETFs, indices, and it could tell you what's working now, and this is a bullish search. I will tell you during very strong times I get numbers up here in the 800s. So the fact that I've got only 1, 2, 3, 4 things above 200 tells me that this is not a very strong market. It also shows me what I already knew, that biotech, pharma, and the dollar are what's leading this market. So biotech, which was the #1 industry, is what's leading this market. Pharma, and then whenever you see the dollar, obviously that's weak. Now, if you look at the technicals on biotech, this here in light blue is a day trading system. In yellow is sort of an investor, and in the pink is the swing trader. And it just gives you a sense of their historical trend of the algorithmic score. So I remember a while ago I asked Rob, could we get something that shows day over day change or week over week change? And they came up with something that's awesome, and it's called the hot selections. So I actually have a system here, hot stocks, and it brings up, let me show you where it is if you've got the program, right here, hottest moves, show only the hottest moves, boom. CGen, Insight, and Dollar Tree. The first two are biotech. Now, CGen is a subject of takeover rumors, but Insight's a stock that's been in a long-term downtrend, and theoretically, from a Weinstein staging perspective, it's already, at minimum, it's in a stage 1. It might be an early stage 2 run-up, where relative strength is broken out, the weekly bond goes green, and the daily shows a breakout here, a retest, and it's running. So if you look at the technicals on this, you could see how much from a swing trader perspective, the algorithmic score went up over the last couple of days. So the hot stocks thing is cool. You can put anything in there, mutual fund, ETFs, futures, and so on and so forth. Let's go back to my bull scanner because I'm bullish, although tempered bullish. And we talked about biotech and pharma. If I go into my CAT scanner, and this is a tool that was designed for me, and I offer for sale on that site when Rob Hoffman has events that we sell it at. We just finished one of those, which was the Wealth 365 event. Right up to the top, because the way I have this set up, I have it set up for price 5 and 500,000. Those are arbitrary and personal preferences. I want them to have options, so it has to have at least a level 1 on liquidity of options. Bullish dot, no bearish dots, and I left everything else the same. What comes up to the top, the first one's Allogene Therapeutics. This is biotech. Now, you don't like seeing the red candle here for sure, but it still was a very up day. It was up 8%. And what I like about it, think about Weinstein stages. It was in a downtrend, then it went sideways, probably not enough. It's not very long, and now it's had some bullish characteristics come in, all my green dots here. Going back to this point, you've had one red dot and many green dots. You broke above the 200-day moving average on Friday with high volume, breakout, you broke out prior highs, and momentum out of a squeeze with OBV and relative strength turning up. So Allogene, which came to the top of the list, looks interesting. I mentioned financials. How about Citigroup? This is a different trade. This is more a bottom fishing trade because in Allo, you've got to go back until January to have higher highs. And the hope is that most of the people that bought back here in here have already sold, and that you're not going to have to fight their selling to go higher. Now, I'm just talking about what I see. I'm not saying to buy this stock. And you compare this with Citi, and Citi is so beaten up. You've got people back here, a month and a half ago saying, if only I can sell when it gets higher. So I think the problem with stocks that have fallen so hard, and here's the weekly chart, is that you've got a lot of what's called overhead supply. But what's amazing is you had a gap on volume with a breakout in momentum from a squeeze. The PSAR reversed, your daily bongo turned green, your weekly bongo had already turned green, and look at the massive increase in relative strength in OBV. So financial Citi. And then this was interesting, Norfolk Southern, which is one of the trains. Again, a lot of overhead supply. I'm not sure I'm ready to go into this yet. The relative strength is positive, but not that exciting. And it had three dots with the volume, momentum, and a breakout, but big downtrend. See if I go, you want to see strength? Healthcare, managed care, United Healthcare. Look at this breakout here on four dots with a gap up, volume, and so on and so forth. That's just a beautiful play there. Again, a little bit of overhead supply, but I think that was all-time highs. So I think United Healthcare is likely to make an attack on all-time highs. So you can go through the list, and what it's done here for you is it's brought the best of the best up top. So let's just pull in biotech and pharma because they're the best groups, and I have watch lists for those. All right, so here's the Allo. AstraZeneca is a big pharma stock, and a lot of them over the last couple of weeks, we called out Bristol Myers, we called out Eli Lilly, have had big moves. And you could see off the highs, but AstraZeneca had two dots. It's broken above the moving averages. The 17 has already crossed the 50, and that one looked interesting. IONS, if I remember correctly, looked interesting as well. Similar pattern to AstraZeneca. A breakout above the moving averages will have some issues with overhead supply. So this is just a way to pull out the best of the best. Let's look at Lilly, which we talked about a few weeks ago on my morning video. You can see Lilly has had a beautiful run, breaking out above the moving averages here, which is, I believe, when we talked about it, and it's had a nice pop and run. So there is strength in this market. You just have to go into the right groups at the right time. And then I'll just finish with Amgen as one of the long-term leaders in biotech and one that looks like it's having a little bit of life as well. On that note, I'm going to say goodbye. Have a great week. Remember, well, I can't say remember this. Let's just go back to 2009. So let me go two more things I want to, actually three more things. Let's start with Netflix and Nflx. I said that Netflix has an interesting pattern. I wouldn't be buying it now unless you know something because of earnings. But Netflix, after this, I believe, earnings related drop, almost positive that's from earnings, has gone sideways. And it had three dots. It had volume, a breakout, and momentum from a squeeze with some improvement in relative strength on Friday. I'm going to watch earnings, but I'm probably not interested in playing a stock, I think Tuesday or earnings, before earnings come out in this market. I think there's too much danger unless we see that the market starts rewarding bad earnings, and then I'll revisit that idea. But we're just starting this earnings season. Let's go to, I think let me see if I can move this down a little bit. Let's go to Indices Weekly, and let's just take a look at the spider. And let's go back in time. And that's not a bad time to look at. We'll start there. So this is the recovery on the weekly charts. And yes, everybody wants to tell you they bought on March 23rd. They may have. I may have bought some. But the safe time to have bought was over here, which was in July. Why was this the safe time to have bought? Because everybody, myself included, would have thought that this thing would have rolled over and then it went. But what you had was it broke through the 50, retested. This to me is the part that was the buying time because you had a chance to pull back, retest, and you held support there. So yes, you would have made more money had you bought the first day the market had a turnaround. But even buying here, you caught the majority of the move. The key here is capital preservation and not who gets the best return on the first couple of days after the market reverses, because a lot of people thought the market was going to do that. So you don't have to be in the first day. Heck, you don't have to be the first week. Let's see if we can find March 2009. I don't know. I get out of that. March 2009. I'm going back far. We're going to get there, I promise. We just got there. All right. All right. Well, we know that March 2009 was a terrific bear market, and this is where we reversed. Okay, March 9th, 2009. Mark Haynes on CNBC actually called the bottom on that day. I was watching it. But let's be honest, okay? We're honest here. I'm not selling you anything, so I don't have to make anything up just to get you to buy my stuff. That looked like a low, and it didn't. That looked like a low, and it didn't. How do you know that that was a low? How do we know that that was a low? Was it because there was great volume? No, not at all. All right, so had you bought the spiders, or in this case, this is the IWM. I wanted the spider. Well, this is the teaching, so it doesn't matter. Had you bought on this date, you'd have been very happy. Had you bought on this date, which to me is probably the exciting day, because you broke above the moving average, you retested, and took out your most recent highs here. So one of these 2 days. Let's say you bought here, so you were late. You bought at $52. So you bought at $52. Do you think it mattered? There's $173. Do you think it mattered if you missed the first $5 off the low? No, you don't have to be that guy or that woman. You don't have to be the first person to get in the market. I think that right now the risk is still high. The risk is high that we're going to see another downside move. I wouldn't be all in at this market, even if this is the bottom. And then the last thing I want to show you, so I get this, if I remember everything, I showed you the Nflx, I showed you the market bottom. Think. Oh yeah. How is this chart different than all the other charts that are applying the weekly bongo? Oh yeah, I missed something. And the moving averages on the weekly. You got green and everything's above their averages. These are the contra ETFs. If you feel like you've got to play a bear market and you want to have positions that you can trade like a stock that you can buy long and hope the market goes down, I'm a big fan of the contra ETFs. This is a S&P, goes up when the S&P goes down. This goes up when the Qs go down. This goes up when the Dow goes down. This goes up when small stocks go down. This goes up when semiconductors go down. That one is showing a little rust. This one, which is red here, so it's don't touch, goes up when biotech goes down. Well, biotech is strong. This one goes up when energy is weak. This one goes up when the world is weak. This one goes up when ARKK is weak. Well, ARKK showed some strength, so it's red here. This goes up when financials are weak. This one is likely to be potentially pressured this week. This goes up when gold is weak. This goes up when mid caps are weak. And this goes up when real estate is weak. Notice the green weekly bongo. Boy, is the weekly bongo a great tool. Let's go back to that chart that I was playing with over here. And let's go back to 2009. You know what? Let's flip it to the spider. I'm going relatively fast today. I'm not one of my 2-hour marathons. So here's the spider. And let's take this one back to 2009 because I want to show you something. All right. There we are. Again, if you were live in the market, and I was, and you were looking just one day at a time, that looks like a low. That might have been a low. Oh, that's the low. That's the low for sure. That's the low for sure. And then you finally get the low. There is one thing on this chart which tells me that this was the one that mattered. The break above the moving average. Okay, the retest, which is beautiful when you can get it, and the fact that you got the weekly bongo turn green, and that's where you captured most of that gain. Now I'm going to pause this for 1 second. I'm going to close on this chart. So we talked about, let me see if I can get this to show in screen mode. Maybe it's because I got the other one on. Let's see what I can do here. Oh, I know what I got to do. All right. Actually, let me pause it. All right, it took me a few seconds. So I showed you this already, which is the spiders, the Qs, the Russell, and the diamonds clearly rolling over. Does this look like the end of a market correction? I'm afraid not. Could be, just doesn't look that way. And I just wanted to show you 2002, 2003. When did you know this was over? When you crossed the 30 period moving average
and your weekly bond will turn green. Notice the fall, there was lots of green as it pulled back on these rallies. We haven't had one green shoot on these rallies. 2008, 2009, you crossed the 30-week, the bongo turned green and stayed green. 2018, 2019, you crossed the 30-week, the bongo stayed green. And 2020, you crossed the 30-week and the weekly bongo stayed green. It happens time and time again. I use it on the sectors and I use it on the contra ETFs. So, on that note, let me get out of this and get out of this and get out of that. So I'm going to say goodbye now. For those that own my marketplace package on Wealth Charts, there will be an educational program Saturday the 23rd. You should be getting notification. I don't have those. I've told them I'll do it from 10 to 12. I'm pretty much certain that that's going to happen. They should come from Wealth Charts. If you have questions about the package or you missed the Wealth Charts event and you have interest, I can always ask Rob, but he's pretty much a stickler about he only offers things for sale during those events. But because of the education program coming up, he might allow somebody to sneak in. Have a great week. Be careful out there.